Right, this is a short video on fiscal policy. Fiscal policy is a demand-side policy which is used by government to try and achieve macroeconomic objectives. If you remember, there are four macroeconomic objectives: low inflation, economic growth, sustainable economic growth, low unemployment, and a balanced payments equilibrium. And fiscal policy is one of the approaches the government can use to try and achieve these macroeconomic objectives. Fiscal policy involves doing one of two things: either increasing or decreasing government spending, or increasing or decreasing taxation, or a combination of both. And the reason that the government does these is to influence aggregate demand within the economy. Right, how does it work? Well, let's say that they want to expand the economy. They want to achieve more demand within the economy. In that case, they would either decrease taxation and or increase government spending. If they decrease taxation, for example income tax or expenditure taxes such as VAT, what will happen is that people will find that they have an increased disposable income. They have increased purchasing power, and as a result they will go out and they will consume more, so consumption will increase. At the same time, they could cut corporation taxes, that is tax on company profits, and as a result firms would have more money left after the government has taken their share of the profit, so they'd have more money to plough back into the business, and there could be an increase in investment. So a decrease in taxation will normally lead to an increase in consumption, an increase in investment, and therefore an increase in aggregate demand, assuming all other things remain unaltered. The ceteris paribus assumption, assuming all other things remain unaltered. Alternatively, they could increase government expenditure. Government expenditure falls into two categories: current spending, things like teachers' pay, very important, things like bandages and drugs for hospitals, but also capital expenditure. That is spending on buildings, roads, man-made means of production which will be used to produce other things. If a government increases government expenditure, if all other things remain unaltered, aggregate demand will increase. We can show this on a diagram. In this diagram here, the increase in aggregate demand shifts the aggregate demand curve from AD to AD dash. In other words, the shift is to the right. As a result, we move from the initial equilibrium to new equilibrium. What's happened in the economy? Well, there's been an increase in output. In other words, we achieve economic growth. We can assume that because of that economic growth, more people will be needed to produce the output, and so unemployment should fall. The bad news for the economy is that there's an increase in the price level. In other words, there's an increase in inflation within the economy. Now, this is the standard argument of how fiscal policy can operate in an economy. It operates on aggregate demand. There is the possibility, however, that some types, and only some types, of fiscal policy may influence aggregate supply. Let's take, for example, the idea that the government spends money on research and development for universities, or it spends money on building new schools. All of these things would lead to a better educated, more productive workforce, and so in the long run this would shift aggregate supply to the right. The outcome then would be that you'd get increased output in the economy, reduced unemployment, but also you would have a decrease in inflation. The economy would become more competitive internationally, and we should see an improvement in the balance of payments. The first thing to remember, though, is that this supply side effect is a secondary effect. Normally, when you talk about fiscal policy, you want to concentrate on the demand side effect. Okay, you will then normally have to ask yourself, what's the problem with fiscal policy? And the problems with fiscal policy is that the government often doesn't know the size of the outcome, the extent of the effect on the economy. That's because for any increase in aggregate demand, there will be a multiplier effect. And unless the government knows the multiplier, it's not going to be able to say the final effect on the economy. A further problem with fiscal policy is that of time lags. If the government decides to increase government expenditure, it doesn't happen overnight. It'll take time to plan the expansion of the university or the building of the hospital, and it won't actually be up and running for a couple of years. So there are time delays in fiscal policy. Any tax change is normally planned a year in advance, and people don't get a lump sum in their pocket, they get a small amount over months. So it takes time for them to realise that they've got an increased disposable income. The major problem, or the major thing that will determine the effect, is where is the economy to begin with. If the economy is over here with much excess capacity in the economy, you could have an increase in aggregate demand which would lead to virtually no inflation. Whereas over here, as we approach the vertical inelastic part of the aggregate supply curve, any increase in aggregate demand is going to lead to a larger increase in inflation. So that's always a good point. What is the relationship with the scale of the increase in inflation as opposed to the scale of the increase in output? And the last thing is that fiscal policy works on the assumption that all other things remain unaltered. So we're assuming that if you cut taxes, people will spend more of their disposable income. But what if there are offsetting factors? What if consumer confidence is low and so people don't spend, they save the tax rebate that they are given? What happens if the exchange rate moves against us so that exports fall at the same time, offsetting the increase in aggregate demand? So you can always think of offsetting factors which may mean that fiscal policy is not as successful as the government would like it to be.